If your salary has not increased this year, you just took a hidden but very real structural pay cut. Global supply chain disruptions and geopolitical conflicts raise the baseline cost of essential goods. For emerging markets, the impact doubles as local currencies lose ground against the dollar. When the United States Federal Reserve raises interest rates to protect its own economy, global capital floods out of emerging markets and flows back into the U.S. To stop the bleeding and prevent capital flight, central banks like Bank Indonesia must react. They hike domestic rates, reaching levels like 5.5%, making borrowing more expensive across the entire economy. Look at the relationship on this chart. As the currency depreciates, imported inflation spikes. In response, domestic interest rates climb. The math is uncompromising. If your nominal income remains static while these three metrics intersect, the market has already quietly liquidated a percentage of your purchasing power. This high cost of capital triggers what we call a corporate winter. Companies can no longer borrow cheap money to fund aggressive expansion. They prioritize survival. When executives audit their balance sheets to cut costs, labor is often the largest line item. The direct result is structural workforce displacement, hitting the middle class directly. Think of your professional career in investment terms. Your salary is essentially an unhedged equity position in a single, highly vulnerable company. If that company decides to restructure, your income goes to zero instantly. Depending entirely on labor to generate wealth leaves you completely exposed during a macroeconomic stress test. You cannot control the Federal Reserve, and you cannot dictate corporate layoffs. But you do control the mathematical engine of wealth retention, your savings rate. This SRY formula calculates years to financial independence. Investment return plays a role, but your savings rate dominates. If you increase savings from 10 to 50%, the timeline accelerates drastically. You don't need risky returns to cut decades off your working life. Your financial survival is not dictated by the absolute magnitude of your salary. It is determined entirely by how efficiently you retain it. The friction point is how retail investors handle retained capital. Most suffer from cost avoidance syndrome. They want long-term equity returns, but refuse to pay the psychological price required to capture them. Look at the historical performance of major indexes. The long-term trend points up, but is punctuated by violent contractions. These drops are routinely labeled as losses, but mathematically they are fees. The market charges a steep volatility fee to compound your wealth over decades. Institutional investors understand this contract. They achieve massive, multi-decade returns by enduring excruciating psychological fees without flinching. Volatility is the admission ticket to long-term wealth. Attempting to dodge that fee by panicking and selling at the bottom is what destroys capital. The real danger lies in timing. Severe market contractions almost always coincide with peak corporate layoffs. This creates the trap of forced liquidation. When workers lose their income, they still pay rent. Without a cash buffer, they are forced to tap into their investment portfolio just to survive. Imagine a portfolio drops 38%. At the exact bottom, the unemployed investor extracts capital for living expenses. This permanently flatlines the portfolio. But an untouched portfolio absorbs the volatility fee, and the full capital base violently compounds back to previous highs during recovery. Macroeconomic crises do not inherently destroy wealth. A lack of personal liquidity forcing a behavioral error at the bottom of the market destroys wealth. To survive the winter without triggering forced liquidation, you need a structural solution, a barbell portfolio, built around a behavioral firewall. One side holds hyper-conservative liquid assets, cash, short-term time deposits, and money market funds. This capital is designed purely for survival, not return. Because money market funds invest in short-term debt instruments, they maintain near-zero historical drawdowns. When the equity market drops 38%, this side of the barbell remains completely insulated. You can reinforce this side further by aggressively acquiring government retail bonds during a central bank rate hike cycle. You lock in peak yields while maintaining absolute capital security. The other side of the barbell holds your growth engine, volatile equity mutual funds. Because your living expenses are covered by the firewall, this capital can be left entirely alone to absorb the market's volatility fees. The firewall exists specifically to fund your physical survival during a layoff. It guarantees you will never be forced to liquidate your growth engine at the bottom of a crash. Historically, only large institutions possess the tools to dynamically rebalance risk like this. Today, the infrastructure is available to retail investors. The digital democratization of capital markets in emerging economies like Indonesia has introduced regulated wealth platforms that remove the friction from portfolio management. Instead of manually crunching the numbers, investors use algorithmic robo-advisors to execute modern portfolio theory, entirely removing human emotional bias from the equation. When severe macroeconomic volatility hits, these algorithms detect the shock and automatically transition the portfolio into a defensive posture. The system systematically reduces exposure to downside risk by siphoning capital weights out of the highly volatile equity pool. It immediately reallocates that capital into money market funds and government bonds, fortifying your behavioral firewall in real time. The blueprint is exact. Maximize your savings rate, build a rigid behavioral firewall, and let algorithmic infrastructure manage the market's volatility fees. Institutional wealth is not generated by predicting the corporate winter. It is generated by mathematically structuring your personal balance sheet to survive it, uninterrupted.